Hey everybody, what's going on? It's Thursday evening, and you know what that means? It's the live stream. We're going to be talking peer-to-peer lending tonight. May do a little bit of stock stuff at the end if we don't go on too long, but hope you're all doing well. Please hit that thumbs up button if you can, so I don't have to nag you about it. Let me move the chat. And do you notice anything different? Today we are colored red to match the Fusa t-shirt. Nothing else. Small things. It's interesting to switch it up sometimes, isn't it? So hopefully you didn't melt in the heat wave that you had in the UK. It's very hot here in Orlando. It's about 39 million degrees today. Definitely anybody that thinks global warming isn't happening is crazy. It's definitely happening. What are we going to talk about today? We're going to talk about the news, a little bit of news. We're going to talk about LendInvest bond offering. I did mention last week about that bond offering and my thoughts on it. We're just going to look a little bit more at that, do a little bit of news, and towards the end of the stream, I'm going to show you my actual peer-to-peer lending results for returns for the tax year of April 2021 to April 2022. And I'm going to show you from worst to best which of the peer-to-peer companies that I invest through, which ones have done well and which ones have pooed the bed. So I have those results for you, so stick around until the end. If you're watching on catch-up, you can always fast forward to the end if you want, but I recommend watching it all because it's fun. Anyway, quick shout out to everybody who wants to be shouted out. Colin Perry in the Peak District, Paul in Kenilworth, Peter Vince from Leatherhead, Peter, nice to see you. Stephen Hale in Nottingham, Robert Pates from Crete. I'm sure it's very hot over there too. Dave Dawson from Staffordshire, and Brian is here from Woburn. Hi to you guys and to everybody else who's watching. Mike Powell is here, of course, in Southampton. Sunny Sutton, as we call it. My neck of the woods. So, let's get right into it. No need to stand on ceremony, as they say. All right, so last week we spoke about this LendInvest bond. Now, I know some of you out there are LendInvest investors. You like the company, as do I. They came out with these bond offering. I think it's £1 billion. It's a pretty big bond offering. It's for them to acquire more capital to do more things with. These bonds are called LendInvest Secure 2 income bonds. The guarantor, this is very important, is the LendInvest PLC. So they're guaranteeing their own loans. These bonds are going to be secured by the property. And they're going to be 5-year bonds that will end on the 8th of August 2027. Now, that's not to say you have to stay in them for 5 years. You can trade them like you would a stock if you want. I wouldn't recommend it. These are going to pay 6.5% per annum. The face value be £100. Minimum investment £1,000 to start. And once you bought your first 1,000, I think you can then order whatever you want. If you want to buy these bonds, you'll be able to do them through places like Hargreaves Lansdowne, I think AJ Bell, places like that. Now, if you're really into details, you can read the prospectus. And it is a long one. It's 186 pages of very, very dry financial stuff. Some of it, I don't even understand. And I've read a lot of these things. For instance, one of the most difficult things I found to understand was how they actually price these bonds. And there's a whole section, I think it's on page 56, that explains how they price them. And I really just couldn't be bothered, honestly, to understand how they price them, because number one, I don't plan on buying any of these bonds. But if you're really into numbers and you want to read the technicals on these things, you can go to lendinvest.com/invest/listed-bond-3, and you can find out all about it. The one thing that I think is very important, if you go to, for instance, Hargreaves Lansdown, there's going to be selling these bonds. You can do a little quick read on this. One of the most important things to know, if you're buying these bonds right here in the yellow, let me zoom in a little bit for you. It says once launched, the price of the bond will rise and fall depending on various factors, including, not limited to, the outlook for interest rates, yields available from other investments, particularly government issue bonds, and the credit worthiness of the issuer. If you sell on the open market before the maturity date and the price has fallen, you may get back less than you invest. So if you're not familiar with this type of offering, kind of operates like an equity stock. You can buy these things on the tradable market like you could an equity or a stock, and the price of it is going to move. So if you're not planning on holding it long term, just be prepared. If you pay 100p per unit day after release or on the day of release, that price could essentially drop to whatever the market decides the price is worth at the time, demand and supply. So don't try to trade at this like a stock. It is not like that, and it is not even though they're paying you a fixed interest rate, the price of the bond is actually going to fluctuate. So there is a level of risk involved there. Also, Hargreaves Lansdown gets a 0.5% fee of the value of the bonds allocated to you, so there is a cost to you buying these things. Would I buy them? No, I would not buy them, because you're really essentially buying a bond which is lending money to LendInvest. So if something happens to the company, yes, the bonds are secured by the property that LendInvest invests in. However, we have also seen, what happens when a company fails. Sometimes those pieces of property are not realizing the sale amounts of what the valuations are. So that can really affect the price of this bond. And also, you always have to be kind of mindful that it is possible any of these companies can fail. Even though I think LendInvest is one of the stronger companies out there. But £1 billion is a lot of really essentially debt that they're issuing, because they're issuing these bonds, which is essentially debt, paying you an interest rate. They're using that money that you're going to put into these bonds to try to expand their business. So there is a definite level of risk associated with that. If you're getting paid 6.5% fixed for 5 years, use your mind to think about how much does LendInvest actually have to generate an income to be able to pay you 6.5%. One would think they would need to generate 8.5%, 9% to be able to pay for 6.5% returns. So, I personally will not be investing in that. I don't think it makes a lot of sense for me. But not financial advice. Do your own due diligence. Kick the rubbish bin if you need to. That's that. Blend Network appoints long-term investor as a director. So Blend has had a long-term investor who has now become a non-executive director in the business. Blend Network is always one of these companies that's expanding, adding qualified people to their team, even though this person is not going to be an active executive within Blend Network. They're going to be on the board. That's Michael Levy. He is a manager of Humor Advisory. To be honest, I have no idea what that is. But he's been investing in Blend Network since 2018, and now he has become a director of the business. Peer-to-peer Finance News says Levy has approximately 30 years experience in financial services. He worked at several Euro banks, including Barclays, and he co-founded 360 Asset Managers in France. 2009 and Yuma Advisories in 2015. So seems like the guy has a lot of experience. He is going to be a non-executive director for Blend. Zopa has lost $41.6 million in 2021. Thankfully, you don't have to worry about this anymore because Zopa is no longer doing peer-to-peer loans. But something interesting, that their losses were continuing to add up. Definitely, I think, going to be better just focusing on their banking. This one, Wellesley, continues wind down, registers further losses. Not a surprise at all. Obviously, they are winding down because they couldn't make money. So it's saying here, property lender Wellesley has registered a loss of $520,000 for 2021 as it continues to wind down. In 2021, the firm did not generate any income, and they incurred administration expenses of $520,000, mostly in relation to financial conduct authority fees. This compares with $941,000 in income generated in 2020 and a £1.03 million loss. So thank God that Wellesley pulled the plug on this business because it just looked like nothing was going right for them. Unfortunately, they wound it down, and it still remains to be seen how much investors are going to be able to recoup from that. In its latest set of accounts for the 12 months ending December 2021, Wellesley has set its cash reserves of $1.48 million, which it expects will be enough to cover the cost of winding down, which are estimated at £225,000. I've found always these estimates are never correct. They estimate low. The administration costs always end up coming in higher. So we'll see what happens with that. Another one. Money Thing administration fees are nearing £900,000. I mean, this is crazy. They've reached £872,608 and 50p to date, 5 months before the administration process is set to end. Personally, I don't think that this administration process is going to end in 5 months. These things drag on always much longer than estimated. This is another case of, I think it will be. Interestingly, down here, and you can look at kind of the history of why I say such things. Moorfields initially estimated that the administration fees would amount to £430,367, but then they revised it to £728,837. In a positive note, by June 2022, £3.2 million has been recovered from Money Thing borrowers, and these funds are being held in a trust for investors with the first payments to be distributed shortly. So I think this is a very important thing to note about administrations here. These administrators always come in low. 430,000 was the estimate. You're already up to 872,000, so they're 100% over, and we still got 5 months before the administration process. So I expect this number to be probably £1.2 million within 5 to 6 months. So again, we hope that good things will come out of that administration, but at the end of the day, we never quite know. If you're a money platform user, you were hit with a surprise. 300 of its customers were surprised by withdrawals that happened from their accounts by accident on the 22nd of July. And apparently this was a technical glitch by the payment service provider MangoPay. They are working with MangoPay to ensure that all money platform customers receive a refund. And hopefully this doesn't happen again. Metro Bank is being held up by rate setters loans. It's helping them to narrow their losses. During the first half of 2022, consumer lending increased to 10% of Metro Bank's loan book, largely down to the acquisition of RateSetter. Over the 6-month period, losses at Metrobank narrowed to $60.2 million, down from $245.1 million in 2021. I can't even get my head around such a big number as being a loss. You know, a company losing £245 million, and a bank no less. I mean, I didn't think it was possible for a bank to lose that amount of money, but apparently RateSetter has helped stop the bleeding. So maybe there are some good things that came out of that acquisition. Plend partners with Lendology to improve financial inclusion. So Plend, which I don't think you can invest yet, unless you're one of the early adopters, but we're hoping that will be released soon. Plend is partnered with ethical lender Lendology. The reason I mention this, a lot of people are always asking me about ethical lending. So Plend is a company that is trying to take on board the ethical lending through Lendology, and that will improve financial inclusion for homeowners across the southwest of England. The partnership will see Lendology use the open banking score system powered by Plend to serve more people and ensure fairer lending outcomes. So that's good. I like to see things like that. Okay. Next, we are going to look at my actual peer-to-peer lending results from April 2021, should be the 6th of April 2021 to the 5th of April 2022. I'm going to show you these real results of my personal account. And, you know, the thing about peer-to-peer lending is no two accounts are going to be the same. Highly dependent on what type of loans you picked up, whether you were doing auto lending, what type of products inside the auto lend you were on, even things like Loanpad. If you had a mix between the classic and the premier account like I did, I mixed some of it around a little bit, you're going to have different results. So again, these results are not going to be the same for everybody, but I wanted to show you what mine were like, so you can kind of get an idea and see if they match up to yours. Hopefully some of them are better and some of them are worse. Well, I don't hope that they were worse, but so let's get into it. These are the peer-to-peer lending results, and we're going to go from worst to best. So if you're enjoying this stream, hit the thumbs up and subscribe if you're not already subscribed. So let's get right into it. This is the worst performer for my tax year, April 2021 to 2022. RateSetter. They got completely disqualified because honestly, I tried to go into the RateSetter backend and download some statements, and the website just errored, and I wasn't able to get these results. So they technically would be DQ'd from this contest. Let's move on. Unfortunately, the worst performing one for me personally was AbleRate. I took a minus 18% hit on this peer-to-peer lending company, mainly because I had a couple of loans that were defaulted and totally written off. Unfortunately, that one has not been a good one for me. Fortunately, I've not had too much money invested through this, so you can see here I got a cryy face because that's how I felt about my AbleRate returns for that 1 year period. Next up, we have Property Partner. Property Partner, I've been sour on for a while. It seems like with them, everything's just come to a standstill, and 2021 was not a good year for me in Property Partner. It could have been a lot worse. A minus 3.7% return, as I did try to sell some of my shares for some of the properties in there, and I think I sold some at a loss just to recoup some cash that was just sitting in there, and none of these shares were increasing in value, so I took the hit. Could have been worse. Minus 3.7%, not the end of the world. Next, LendingWorks. 0%. Yes, cryy face for that one because LendingWorks paused everything for a good amount of time and decided to pay their investors nothing. So they get the big fat 0. What do we got next? Funding Circle. Actually made 1.6% for that tax year. Had a very, very small balance in there. A lot of that return actually came from previous defaults that were recovered. If those weren't recovered, that number would have been definitely in the minus. So some recoveries that happened there, it wasn't such a bad thing. Next up, we got Loanpad. 3.67% average for that 1 year. I get a happy face for them because they're basically paying what they say they're going to pay. Nothing more, nothing less. Nothing really to figure out about Loanpad. More than happy to get that result. And I like what Loanpad does because they do what they say they're going to do on the 10, which is pay you a certain percent daily interest. You don't have to guess anything. So they get the happy smiley face. Next up, Kuflink. 4.3%. A little disappointed, I have to say, with those Kuflink results. I thought they were going to be higher. I thought it would have been closer to 5.5%, maybe approaching 6%. So I have a neutral face on that one because I think I could have done better. 4.3% is okay. Not really beating inflation at all, not even half. But as it goes, a little bit of a disappointing result for Kuflink. Hopefully it's going to be better in 2022 to 2023. Next we have LendInvest. We just talked about their bonds, which I will not be investing in, and 5.3%. LendInvest is just another one of these companies, and it gets the happy face, that has pretty much done what it has advertised it's going to do. Nothing more, nothing less. Been very, very consistent. I think I've been with them for 5 years. Nothing has really changed. Money just continues to get reinvested in the auto product, and that 1 year rate, 5.3%, is exactly what I thought would be achieved through LendInvest. So good job, LendInvest. Next, we have Assets Capital. Surprisingly, I thought these numbers were going to be much worse, but I managed to somehow achieve a 5.6% annual return from 2021 to 2022, which I was very happy with. I was expecting that to be much lower than that. Assets is one of those big behemoth companies when it comes to lending that some of my manual lending loans have been kind of in no man's land, a little bit stuck, but now they are starting to ramp up the manual lending investment account too. They have new loans coming out over the next few weeks. If you're a investor in Assets Capital, you're going to have seen that email come through saying get your capital ready to go because these new loans are coming through. And that was a pretty good result, I think, for the year. I was happy about it. Next, we have Unbolted. Unbolted is always the dark horse of the peer-to-peer land. They're a relatively small company, and they just seem to fly under the radar. They do what they've always done, and they continue to provide good returns. So we saw a 7.7% annual return April to April, 2021 to 2022. Really, really happy about that. Not really much more to say. As long as they stick to doing what they know how to do, I think Unbolted is fine. You know, hopefully they don't go into crazy property lending or do some of the other things that have taken some of the other peer-to-peer companies down, and that's to veer into asset areas they don't know anything about. But I think as long as Unbolted continues to stick to their pathway, they should be fine. Really, really happy with their result. And finally, number one in my own personal portfolio is Crowd Property. 8.5% return year on year. Very, very happy face on that one. Again, this is April 2021, April 2022. Things can change, but during that period, 8.5% achieved using completely auto pay, no manual lending, no trying to snag loan pieces on the open market. I just let the crowd property system do what the crowd property system does. And, you know, getting 8.5% nowadays in an investment, very, very difficult. So the fact that crowd property was able to do that, I was impressed. So, yes, to recap, from worst, and I do consider RateSetter not as returns, they weren't the worst. I just don't know what that number is. So technically dequalified, but able rate for me personally was the worst at negative 18%, and crowd property was the best at 8.5%. If you couple all of those numbers together, I don't know what that final return amount was, because I've got different amounts of money in each of these different companies, so I haven't had a chance to figure it out based on ratios, and I don't really think I could be bothered to do it. But I was really surprised by some of those numbers, happy with some of them. Again, Loanpad, no real surprise, but hopefully Kuflink will be better for the year. Crowd property continues to be good. Bolted continues to be good. And really the goal now is just to try to beat inflation. Try not to make wrong moves by investing in companies that are not very strong. That's what we want right now. And do a little trading 212 update, since I don't think we've been going for that long. Today it was kind of a quiet peer-to-peer lending. Yeah, look at that, 32 minutes. Yeah, really kind of a quiet week for peer-to-peer lending. So let me show you what's going on in the 212 portfolio, since I haven't had a chance to do the Tuesday stream for a while. And look, I'm not even talking about crypto today, but I might mention it. Okay, here's the portfolio right now. It's back down again, 16,860 pounds. It was doing better. We were at our high point 17,660, so we've dumped about 800 pounds off this portfolio, mainly because of this Arch Resources. They are having a really, really bad day after having a good day yesterday. Pre-earnings report, $145, and now we're down to $128. It's been kind of roller coaster day for Arch. They reported earnings. Earnings were really, really good. Really good. But the market didn't like the dividend cut that they had announced. Most people thought it was going to be about an $8 per share dividend. Came down, turned out to be $6. The market just hammered Arch today, which is our biggest holding in the portfolio, 7,000 pounds. We went very, very high weight on that one. But you can see Flex is doing pretty good, 26%, and Vermilion, 38% in the red, and then we got this little stinker here, Zim shipping. So the portfolio just seems to keep kind of going laterally. It's not really made any big moves as far as going up, is what I hope this Arch Resources investment would bring in. This is a coal mining play. I don't see the price of coal going any lower. I think it's just going to keep on increasing. This is why the play went into Arch. They announced a revenue of $1.13 billion, which was up 150% year on year, and earnings per share of $19.3. Delivers a record net income for the third straight quarter, achieves record coke and coal realizations. They announced a dividend of $6 per share, yet the market just decided to kick Arch Resources in the balls, give them a good beat down, because that's what the stock market does. There is no reliability. Even when the numbers are like that and come out just so good, the stock can still get stamped on. We're down 11% today. It was about, you can see down here, it dropped below this point, down 12%, then came back to minus 5%, and they just can't seem to hang on. So I'll probably be hanging on to this long term. Again, don't follow what I'm doing. This is very, very risky. but I wanted to show you how the portfolio was doing. I think this could be a lot worse. We've had a bit of a rough time with some of these oil stocks recently, but continue to really stick with the program. I think that's very key when you're investing, is set out a plan and just kind of stick to it. Short-term movements can be extremely costly, so hopefully that portfolio will be better in a month. We'll see if we make any moves with it. And then if you've been a Bitcoin watcher, you'll see that the price has been finally starting to move after really months of it being beat down. At a price of 23,797. It's actually been quite resilient if you think about what's going on. We got this Fed interest rate increase yesterday of 75 basis points, 0.75%, which is going to affect interest rates, obviously. You're seeing it with your savings bank accounts now as those rates start to come up. I think I've seen it about as high as 1.5% in some of the accounts that I personally have. So kind of gapping that distance between Loanpad being at that 3% rate. Now you can get a savings rate of 1.4%, even though the 1.4% is just not really attractive. Bitcoin has made a resilient run over the last week from down here when it went down to about 20,800 and has just really started to make a run again. Is this temporary? I don't know. It's hard to say right now. I don't think we've seen this point where we're going to make this big run yet, but the small run, we're up 10% from July 26th. I think that's a pretty good result considering what is going on with the inflation rate, with the stock market making a run yesterday, and with the interest rate increases. So let me know what has been the worst performer for you in your peer-to-peer lending basket of companies. Have you had the same results as I have? Has it been similar? I was hoping for better results from AbleRate, but that's just a result of me picking a bad loan out. One bad loan took the whole portfolio down. That's manual lending for you. It can be definitely troublesome. You're going to talk about collateral or money thing administration as you've missed all the developments. I have missed all the developments. No, I had not planned on talking about that. If there was a high court ruling today, I did not cover it, Mike. 11% fees. Tell me more. Maybe you could type about that. I'll cover it next week. I haven't had a chance to look into those things. Anyone else notice the increase in peer website promo emails encouraging more investment as many lenders reduce exposure? John, yes, I've noticed that too. It's kind of natural marketing, I think, as things happen, demand and supply, these companies are going to push for more investments. Kuflink also affected. Suggests you check your account. I did check my Kuflink account. I did not see any issues. Can you explain how Property Partner has negative returns when the property market is up 10% year on year? Yeah, absolutely. So basically they sell shares in properties, and those shares are priced on their internal market. So it's really a demand and supply situation. If a property share is in demand, it tends to price up well. If it's not, which has been the situation for most of the shares in Property Partners, individual properties, are just there's nobody buying them. So hence the lack of price movement uptick. Even though the property market has been really buoyant, that doesn't really necessarily affect the price of the shares within Property Partners market system. Plus, they've had some issues with some of the properties that they have on their books, so it's kind of been a bit of a rough company to be invested through. Student property REITs have performed well, so it's not the accommodation type. A little puzzled how your Kuflink return rate is as low, 100% record at 6 and 6.5% range, even mixed in with auto invest. Yeah, I don't know. That's what the numbers are. I pulled the statements, and either there is a accounting issue versus what I've gotten paid, or there are also some instances where I've taken money out and put it back in, so I might not have had a big of a balance as I. So like my balance wasn't necessarily constant throughout the year, but that's what the numbers showed. Some investors online suggest P2p is not high enough for return. Strongly suggest funds like UK-based NYCF 8% return from various large company bonds quarterly minus dealing costs 6% return. Yeah, I'm not a big fan, Richard, of managed funds, so I tend to stay away from them. I think if you're going to go into something like that, you're better off just plunking your money into like a global Vanguard tracker or the S&P 500 tracker. Do you pay for your 212? What do you mean, Mike? I pay the trading fees usually on the FX side. Yeah, US technically in recession. Worst result, Lendy by a large margin. Yeah, I didn't include Lendy or Money Thing or Funding Secure because they're in administration, so naturally those ones are just going to suck. And we don't really know what the actual outcome is of those, so I just included ones that were performing. Crowd property loans, while slightly higher rated, lower LTV than others, not just as quick 100% funding at times as possible to fund as much as 20 to 30,000 yesterday. Yeah, it seems like crowd property are doing a good thing. House Crowd Court granted a Berkeley Applegate order capping admin fees at 11%. That's pretty cool. Good for them. Good for the court for finally doing the right thing by investors. So that means that they are not allowed to charge more than 11% for the administration costs. That's what needs to happen on every single one of these administrators, because some of these fees and charges are getting out of control. I can't stand to see like Lendy's. And I actually, you know what, I did look at the Lendy administration update back from June 23rd, and I saw, hang on one second, see if I still got it pulled open. One sec. I saw the amount of fees that were on that administration update. It's disgusting. Hopefully that will get challenged in court too. This was the 6-month period to May 23rd, 2022. So if you can be bothered to read through this, some of it gets a little dry. I'll show you one of the main things. Where are you? Right here. Joint administrative fees, costs, and expenses. You can see it just racking up. 2019 to 2020, 2.5 million fee estimate. And then for the next year, 1.4 million. So we're up to 3.9 million. And then we don't have a fee estimate here. For year 3, it's probably going to be in the £1 million range. This is a company that needs to get capped for their fees because they are just going crazy. Says time costs incurred since appointment total of £4.8 million in time costs. £4.8 million. That's a lot. And then if we go down, you can see here a lot of zeros in the accounts for some of these loans. A little bit of recovery here, but not really much positive happening through the period from November 24th to May 23rd. I think 346,000 in recovery, so it's way more in fees than is being recovered. So I like the fact that the court has at least ruled on capping some of those fees on the administrative side. It's getting ridiculous. Patty, turn up your volume. I could talk really close for you if that's better. You just can't have these administrators having an open checkbook with no limit to what they can charge. It's not fair on the investors. Even though I know it's hard for them, I do try to look at things from both sides. The administrator doesn't know how long they're going to have to spend on trying to recover loans, but there has to be some reasonable limitation to how much an administrator can cost, because if this drags on for 6, 7, 8 years, the administrator just ends up taking all the money. FCA should bring caps on administration costs. Not easy to do. Something could be done. Agreed. Mike says 11% is high. Funding secure is 2.5%. Lending will be low. Money thing is 17% plus. Yeah, I don't think they should be allowed to take more than like 3.5%. Is P2p a worthwhile asset class? It sounds like including those in administration, your average return is poor. Yeah, my average return sucks because when I was first starting out, I was throwing money at all these different P2p companies. Some of them went busto. I don't think I'm probably at a negative right now. Maybe it's break even zero. Maybe. I would say it's a worthwhile asset class now because there's more information available and a lot of the bad companies have been washed out. So if you're coming in now and you know what to invest in, I think you got a better shot at making some good returns. But if you were coming in the early days, back when some of us were, it was not a worthwhile asset class. You got to diversify too. Oh, okay. So apparently I'm reading the report wrong. Okay. Wouldn't be the first time, Mike. Yeah, use diversification when you're doing peer-to-peer lending. That's the most important thing. Don't put all your eggs in too heavy into one basket. Take a lesson from my trading 212 portfolio. You know, putting too many eggs into this one particular basket here of Arch will definitely has stung. I mean, look at the losses here. Minus 1,100 pounds just on this one stock. That's what happens when you go overweight. You get it wrong. Sometimes I get it right. That one I got it wrong. Same with peer-to-peer, because you don't know at the end of the day which ones are going to survive, which ones are going to thrive. We could make our best guess. We do try to do that and provide information, but you know, we don't always get it right. Anyway, it's 50 minutes. I'm going to get out of here. Hope you enjoyed the stream. I will try to be back on Tuesday if I can, depending on what's going on with life situations right now. It'll be an impromptu stream on Tuesday if it happens. If not, back next Thursday, all being well. I hope everybody has a great weekend. Stay cool out there and respect each and every one of you. Love you all. And we'll see you soon. Take care. Bye.